All right. Hello, fools. It is just past 2 o'clock on the East Coast. As Emily said, this is the Millionacres Hour where we get to talk about all things real estate, my favorite subject. So I'm Deidre Woollard. I'm an editor over at Millionacres, which I'm sure you know is the Motley Fool's real estate investing website. And here with Jason Hall, who, in addition to being the rap host, is also really knowledgeable about home builders, which is what we want to talk about in this hour because I think it's really interesting. 2020, not a great year for REITs, at least some of the REITs. I'd say a large part of the REITs didn't do so well. Not a great year for the commercial side, but man, oh man, the residential side just popped all year. Well, not all year, but certainly since April. And that's been big for home builders. It's been big for some of the real estate brokerage stocks. But today in specific, wanted to talk about home builders, what we think is going to happen and what to look out for. Because if there's anything I think that any long-term investor knows, it's that what goes up, eventually stabilizes or comes down and,
Reversion to the mean, right? That's the thing, I
yeah,
guess. Yeah. Yeah. Yeah.
exactly. I mean, it was such a strong year that it's hard to imagine that 2021 is going to be as strong.
I'm gonna just kind of tease everybody a little bit here. There's a chart. I sent an image of it to Deidre, but half an hour or so ago, on Slack. I'm gonna just tease it. I'm not gonna share it now, but I think the mean might be changing, right? I think that's the way to think about this. This is it's been 2020 was a great year, but the best part of 2020 to me wasn't the final sales results. It was the order build, right? We'll talk more about that, but let's talk about, like, you got a lot of great data here. I think that really just kind of sets the stage for what happened last year and kind of where things are.
Yeah, so where things are, I wanted to look at a few of the numbers. I've talked about some of these before. There's a series of numbers that come out every month that kind of give you a little bit of a window into what's happening. So the one that comes out usually at the tail end of the month is always pending home sales from the National Association of Realtors. And what they saw in November was a slight decrease from the previous month, but that's totally normal. I mean, the slow season is always probably tail end of October used to be through March, but is now more like mid-January. But pending sales are still up year over year by about 16.4%. So even though things have started to slow, which is the traditional cycle, they're still way up over last year. And the interesting thing is to hear what Lawrence Yun, who's been the chief economist of the NAR for, oh God, a long time.
He's great. He's really great.
He is great. Yeah. And he definitely thinks there's still room in this market. He says existing home sales are probably going to go up by 10% in 2021 and new home sales by 20%.
Those and I think we should contextualize that, right? For to see a double digit and a sustained double digit increase in home sales is like the stock market going up 30%, right? Mm-hmm. It is a very big number. It is an abnormal number because it is a very large, very mature market, and it takes a lot of very expensive items being sold to move the needle that much. So it's really a big deal.
Well, and another thing you and I have talked about before is that I think is really changing the existing home versus new home picture is how close the median home prices are between new homes and existing homes. I've studied real estate a long time, never seen them this close. So the most recent existing home price from NAR, $310,800, which was up almost 15% from the year before. So really seeing prices of existing homes go up, partly because inventory is so low. And then if you look at new home sales, their median home sales price in November was $390,000. Now that's a big difference, but it's not as big as it used to be. And so they're starting to become this situation where people are thinking, well, why buy an existing home if I can get a new home for a price that's not too much higher and maybe, not have to deal with some of the hassles that can come with an existing home, particularly a home that is older. I think one of the things that I've been watching is the aging of housing stock in America in general. Mm-hmm. As homes, I mean, it's interesting to me
We're
because
pushing 40 years now, right? It's over
we
35
are,
years. Yeah.
yeah. And, what's interesting is the old homes, I feel like they kind of last forever, like pre-war homes, but
Yeah.
homes that were built I'd say like from the 1950s and on, they have a little bit more kind of built-in obsolescence in them. I see more problems happening, and it becomes harder and more expensive to fix them. So I think that's something that people are starting to see, is they're starting to watch their friends buy a house, and then they start to hear about the horror stories,
Well, and
foundations.
there's a history there that's important too, because that post the pre-war homes were a craft item, right? And then once you
Mm-hmm.
get into the post-war era, they became a manufactured good, and that's the way the federal government is in terms of the different buckets of economic activity. They're manufactured, right? You even a custom home. The bottom line is that they assemble houses, right? I mean, there is some
Right.
custom work, but for the most part, you think about the rafters, you think about even the wall panels, the studs, they're taking sections and they assemble it, right? And they're
Mm-hmm.
manufactured in a facility. So there's the benefit to consumers, right? Is that's driven cost out. I mean, it's not necessarily reflected in the environment now because of the supply demand
Right.
economics, but they're a manufactured good, right? And the bottom line is that for a lot of years, manufacturers, as they do, look to find ways to drive costs down using lower cost materials. Materials as wood has gotten smaller, right? Every single piece of lumber has gotten smaller. A 2x4 hasn't been a 2x4 in almost a century at this point.
Mm-hmm.
So as a result, the quality has been affected, and that's your point, right?
That is absolutely my point. And there's a lot of variation across the country, but my mother lives in one of those housing developments in Florida that was built during the 80s.
The worst.
So yeah, exactly. And the amount of problems with that house as it's gotten older have been incredible.
Mhm.
I mean, really substantial plumbing problems that I found, surprising. It's not that old a house. It was built in the 80s, but it's certainly having problems. And I think there is that problem with some of that housing stock.
Yeah, and here's the flip side, right? We were on, I think I had you and Tyler on the wrap a month or so back, and Tyler was talking about how, some of that issue with the age of the aging out of some of the newer properties, right? So you think about those 80s, especially late 70s, early 80s, like, especially a lot of, composite materials came in that were
Mm-hmm.
junk.
Yeah.
Is like it's like a potential opportunity for like the Home Depots of the world, right? Where they have good relationships with remodeling contractors and that kind of thing, where you have somebody that buys a house that's, an existing property, and then they find out after the fact, I can't do this little DIY project. I need to hire somebody, right? So there's interesting, compelling opportunities throughout the market that are going to play out as the trend of buying homes continues to grow. It's a huge trend.
Absolutely. But I think the difference is, for a home that is, a couple decades old, you start to think, why not just get a new home? Because there's not that difference in like style or it being historic or something like that. And that's really one of the things that's interesting too, is where homes are being built and the amount of permits. So some of the numbers that you and I have been looking at is we usually look at the building permits, which is sort of the beginning start of the process. Then you have housing starts, which is actually the construction, and then you have housing completions. And so those numbers come out every month from the government, and they're still these numbers are strong compared to where they were, a year or two ago, but we're still not building at the rate that we need, and we're still not building at the rates that were in place before the 2008 great financial crisis. We've never gotten back to that point.
We haven't. Is this the part where I show that chart now? Should I do that
Yeah,
now?
show that
Okay.
chart.
All
That's
right.
a great chart.
I'm gonna bring this up here, and let's see. I think that's pretty good. Is that a good size?
Yeah.
So here's what I'm showing. I'm showing this is since 2010, right? So this is since 2010. And I'm showing this one first as a starting point. So you look at the purple, that's housing starts, right?
Mm-hmm.
So that's when those the first process of building that property begins. And then you have US existing home sales, right? So you look at that number and it's like, wow, let's on a percentage basis. What is this? This is, I mean, they're up huge over the past decade. Here's the problem. The past decade is not anywhere near enough context for what's happening here. So we take that back and now look, right? So housing starts over the past 40 years, we're usually pushing, a couple million, right? So I'm going to pull existing home sales out of this and you see, 1.5 to 2 million is more the normal healthy range, right? And if you look, so right here, you see that cursor, that's like 2007, 2006. That was the peak, the pre-global financial crisis peak, the housing. So all of this is a 4-year run of extreme overbuild that happened, right? So, and then the crash here. And so a lot of this was soaking up all of this excess inventory right here. But here's the problem. Here's the thing that there's more context, and I'm going to go even farther out. I'm gonna have to break this up because it pushes that down there to the bottom. So you see, here's the thing that this doesn't factor in, right? So we spent a lot of time in this period kind of soaking up excess inventory, but at the same time that all that was going on, the US population continued to grow and continued to grow, right? So we're talking about, this period here where we're pushing that 1.5 to 2 million starts pretty consistently. Obviously, there were some recessionary periods that it fell a little bit. The U.S. population continued to grow, right? And now we have this scenario where millennials, like the most populous generation in American history, are actively and aggressively looking to own a home, right? And we don't have enough inventory. All right. I'm going to throw these charts right on top of one another. And you see that right here. So this is the existing family home inventory. You see, again, from that peak, it came down as it should have, because there was a massive oversupply, right? But again, if you look at where we are right now, 1 million existing single family home inventory. In other words, that's existing homes for sale. Come on, people. Look at this. I mean, that's historically low. And we have also historically low interest rates and the largest number of first-time home buyers in American history.
Yes. And that's another interesting thing to note is a lot of people have asked, with home prices being so high, has the amount of first-time home buyers did it go down last year? And it really didn't. It's usually around between 30 and 33% of existing home sales. And it's stayed pretty consistent throughout the year. So that tells us that, these prices are high, don't get me wrong, affordability is strained, but because interest rates are so low, people are still feeling like this is possible for them and they are able to do that.
Yeah. And the other thing important too, is that real estate pricing in markets, it's very, very geographically based, right? It's very local.
Of course.
The area that I live in, pricing is much, much higher than like around Charlotte, North Carolina, or around, different places in Georgia, than it is in Southern California near LA, or than it would be in San Francisco or, DC metro area, that kind of thing. So that's another thing that affects it, right? So those median prices and average prices, what you see on a national level might be completely different in one market or the other based on access to land, local population, economic opportunities, all of those things kind of come into play. But the big thing is supply and demand, right? I mean, this is just, there's no inventory, right? And I think that sets up the home builders, right? And we'll talk about that in a few minutes.
Yeah, so there's limited inventory, and there also, the other story that was part of 2020 was that work from home shift, and that's part of this, is that people were starting to think about suburbs again. So we saw what they called the urban exodus, although I still believe that's mostly temporary, and the data is starting to show that is in fact true. As vaccines roll out, people are starting to be more interested in going back to cities. But we saw people sort of move out to the suburbs. And that's always great news for the home builders, because the home builders, obviously, there's very limited possibilities of building, close to cities. They're always having to be in the suburbs and exurbs. And that worries me a little bit with home builders, is just based on what we saw in 2008, is that they built too far out. They built way too far out, and then when the economy shifted and people wanted to be closer to jobs, those homes became less desirable. So that's something that I think is important to keep an eye on.
Yeah, I agree. And I think that the greater context too is we really don't know what the full you know implications are of how the coronavirus pandemic is going to change work in the broader scale. But I think there's
Yeah.
more and more evidence to your point that it's not going to be as binary as maybe we think, right? For every Twitter that wants to have, you know, almost all of their employees working remotely, there's going to be 100 um, Netflixes, right? Reed Hastings was very adamant that he wants his staff working in the office and working
Yeah.
together, right? So I think the reality is that probably the biggest group is going to be the hybrids, right? Where you have companies that want their employees in the office most of the time, but want to give them the flexibility to work from home, a couple days a week, maybe, or maybe for an extended period of time, a week or two work remotely and then come back to the office. So I think we're going to see more of that model kind of play out. But at the end of the day, I don't think that those things are really going to affect the trajectory of the residential real estate market. I really don't. I think the trajectory, especially for home buyers, whether you're buying a single family home or you're buying a condo or whatever, the demographics are blatantly clear here.
Yeah.
There's millions and millions of people that want to buy a home, right? So what those homes look like and exactly where they are that are going to be affected, but the greater trajectory I think is pretty clear.
Well, the other thing too is you also have some of the larger companies making some big moves. So, we've had a couple of different companies move their offices from California to Austin and Houston.
Right.
We've had some of the New York companies that start thinking about what they call Miami, like Wall Street South. We start
Right.
seeing that New York to Florida
I
exodus.
think, yeah, was it Goldman Sachs that did something like that?
Goldman Sachs. Yeah.
Yep.
Yeah. It's
Yep.
Goldman Sachs. Yeah. So you're starting to see these trends of these companies doing that. And that's an important thing to keep an eye on too, because money follows people and people follow jobs. So if you've got the jobs in those areas, then that's all the more incentive for home builders. And certainly Texas, I think, is one of the biggest markets for home builders. We've seen some of the home builders scale back a little bit in California, especially in Southern California, partly because it's just
costs.
Yeah,
Yeah.
land costs are just insane. And so we've seen them even before the pandemic. We saw a lot more activity in Houston and also in across the Sun Belt.
Yeah, and I think that's going to continue. I think there's little doubt that's going to continue. Number one, because of affordability, and also because I think a lot of companies have focused on growing in those areas because they're going to have access to talent, right? And that's important. And they know that costs are better there. And a lot of those areas have implemented business friendly policies. I think a lot of big companies that are thinking about regulatory impact, thinking about taxes, and have the flexibility to move to outside of Charlotte or outside of Atlanta or Dallas or San Antonio or any of those places. They're certainly more Florida. Yeah, they're certainly more business friendly than California, where I live now, where taxes are higher. And regulations are stiffer, and everything costs more. But I don't think we should count California out. I think it's a reminder that for talking about home builders, especially if you're looking to build entry level housing, Southern California is very hard because the costs to build and the selling costs typically will push the price above where it will qualify for as a I just completely drew a blank on the word here, conforming loan, right?
Right.
So when it comes to Fannie or Freddie, you all of a sudden you're in a jumbo mortgage, right? Which can cost a little bit more.
Yeah.
Less lenders want to do jumbo mortgages. So it's an extra level of complexity that a lot of home builders, if they can avoid it, they will. And especially the smaller home builders, Green Brick, we're going to talk about, LGI Homes, Meritage, two of my favorites. They can still grow in other markets and not have to compete in California. So it's good for them. It's not great for people that want to live here.
Yeah, that is very true. And so just to take a look at new home sales, so the new home most recent data is from November, and new home sales were up 21% over the year over year. And so the inventory, the interesting thing is there's more of a supply of new homes than there is existing homes right now. So existing home inventory is right around 2 months, and you figure that what they call a balanced market is about 6 months of inventory. Now, existing home inventory hasn't hit 6 months since the great financial crisis. It's always been trending low, but now it's trending to the point where it's just really, really low. And I'm not sure if there's going to be a big rush to have existing homes go on the market in the spring. So traditionally, you know, March, April, that's when people start to think about selling. You get that big push of homes on the market. I'm not sure if we're going to see that this year. I mean, obviously we didn't see it last year, so it'll be interesting to watch. That's one of the things to kind of keep an eye on, especially if you're invested in some of the home builder stocks. Keeping an eye on the existing home sales is sort of, it's kind of like watching your competition in some way.
It is, and again, it's very regional. So you think about, you want to understand those metrics. If you're investing in these companies, you want to understand those metrics in the areas that they operate in, right? I think that's a really important
Yes.
context to it. And the good thing is that the National Association of Realtors, they break that data apart, right? You can, and it's free. They like it because it's marketing, and it's great. They want as many people to see it as possible. And then the Fed does so much stuff that you can also get for free, in terms of tracking that data and being able to peel it apart. But I think the point is that you want to kind of understand those levers and how they affect the companies that you invest in.
Right. And you also want to look, when you're looking at home builders, you want to look at what their average price is and
Yeah.
what they're selling their homes for. How does it track against the market, and how does it track against the average and the median? Because that's important too. Even before the pandemic, we did see some of these home builders getting a lot smarter about this. Some of the biggies like Lennar and DR Horton were already starting to know that their homes were getting a little bit too pricey for their market. So some of these home builders are pretty smart about knowing what people are looking for, and trying to find ways to make the plans still seem big enough, but maybe make it just a tiny bit smaller, or make the lot size smaller, or anything that they can do in order to basically trim the cost of new homes. And they've done pretty well in that.
Well, and we saw the trend of, from probably 2011 or 2012, when things started to kind of stabilize, and the home builders were really kind of getting back into some semblance of closer to normal business. We saw for a number of years those average selling prices, steadily increased, obviously
Mm-hmm.
based on the supply and demand economics, but also they were focusing for the most part on custom homes, right? They weren't building, nobody was building entry level homes for the first 5 years after the global financial crisis, or very little, I should say. But they were focusing on custom homes because they were selling to people that had jobs and money and were looking for something more, something nicer, right? So that's where they focused. And an interesting thing that I saw with Meritage, I've followed for almost a decade now, is when Steve Hilton, the founder, former CEO, I think he retired at the end of the year.
Mm-hmm.
When he announced that the company was going to really focus on entry level, was he pointed out that their average selling price was going to start trending down, and that was going to be a positive indicator because it meant that the company's focus was working and they were selling more of these entry level houses. And there are very few businesses that you ever want to see average selling prices fall, because if average prices are
Mm-hmm.
falling, usually it means they're selling something that has thinner margins, right? And they're not doing as well. And it's actually the opposite, in the housing market, is that starter homes can be more profitable. You can have better margins because you don't have as much labor involved. It's a format, right? You build one, you move to the next one, you build it. It's the same. Maybe you have 4 or 5 floor plans, but that's it. You're not doing a bunch of custom work that costs more money and eats into your margin. So it's really interesting. I wanted to just stress that, because as you're looking at these companies, if they say they're focusing on entry level, then you probably want to see that metric, if not staying flat, maybe coming down a little bit, because it means that it's working.
Exactly. Yeah, that is a very important point. You do want to, and you also want to know what types, where they're building, what types of homes they're building, and you also want to know how they're holding the land. So that's something you and
That's
I have talked
huge.
about a
Yeah.
lot before, and
Hmm.
that's really, really important is that there are different types. So home builders have this problem, right? They have to have land available to build, but they have to not be kind of caught holding the bag when the market shifts and they don't need to build those homes anymore. So a lot of home builders, instead of owning the land outright, they'll have options, which they'll basically gives them the right to use or not use the land. And so that's one strategy that we've seen home builders kind of shift toward. A couple of the home builder in the earnings reports recently, they talked about how they were trying to shift their ratio of land wholly owned versus options.
Yeah, Lennar in particular, that's one of the
Mm-hmm.
biggest. Is Lennar the biggest? They might be the biggest. They're one of the biggest
Yeah.
home builders. They talked about, I think they're aiming for like 45% of their
Mm-hmm.
land they want to hold in options, right? And just a little more detail on why that's what exactly that means. So if you look at home builders, generally on an earnings multiple PE ratio, they tend to trade at a sharp discount to the market, right? They pretty much always trade for a modest discount. Sometimes it's like right now, it's crazy discounted compared to the market. But there's two main reasons why, and Deidre hit on it. But just to be really clear and specific, what it means is because they historically, most of them have to buy this expensive land that they sit on for multiple years at a time. They usually want to have like 3 years plus inventory. They buy land that they sit on for 3 years, and they use debt to buy that land, right? So they're paying interest on it. So there's a lot of leverage involved. And then the other side of it too, Deidre mentioned being caught holding the bag when the market turns. It's a cyclical industry, right? It can shift very quickly. And 2020 was the most abnormal recessionary year that I've ever seen, where housing
Mm-hmm.
sales went up in the worst recession, the steepest recession in history, right? So that's not normal. That doesn't normally happen. Usually what happens is everybody circles their wagons and stops buying houses. And these guys are left with a bunch of inventory that they're having to pay debt to service. And all of a sudden, they're not selling new houses either, right? So it's like this worst double whammy. So moving to options means that they risk a little bit of capital that they might lose, but they can walk away without buying land, probably at too high of a price. That then they have to figure out, well, do we offload it at a discount or take a loss on it because we need to lighten our balance sheet? Or do we just keep riding it out until the market gets better, right? So all of these things creates a lot of risk for home builders, right? So that's why Lennar, yeah, I mean, their shift to options makes sense, and it's kind of following the NVR model, right?
Mm-hmm. Absolutely. And it's also a way geographically to hedge your bets a little bit
Yeah.
too. So, you can have options in different locations and then sort of pull those into play if there becomes sort of a geographic shift. The migration numbers for 2020, we don't have the final ones yet, but so far, from what I've seen, they're stronger than usual. There was definitely more migration this year. And I've mentioned before, Rich Barton, the CEO of Zillow, has talked about this before, about like that this year kind of unlocked mobility in a lot of ways for people, and that
Yeah.
he sees that as an ongoing trend. I'm not sure how big a trend it'll be, but we definitely, even anecdotally, I just heard about more people moving around this year, trying out new places to live. And I think the millennial generation in general tends to be more open to that and
Mhm.
more interested in moving different places. And you also had this factor of, especially the millennials tend, as they're growing up, they in their 20s they love travel. And I'm noticing as the millennials hit their early to mid 30s, they're starting to scale back on travel, and they're starting to think about putting that money towards towards a down payment. 2020 kind of put that in overdrive because nobody could travel.
Mhm.
So it really was that reset for a lot of people. And that's the factor that I find interesting here, is that there just is this emotional factor that is always kind of present in residential real estate. And it's important to kind of keep that in mind as well, that there is that desire for home that really manifested itself in 2020.
Well, we put down roots, right? I think that's what
Mm-hmm.
happens is, first of all, the backdrop from coming out of the global financial crisis, you had an entire generation that was, put economically and financially behind any prior generation in the past 60 or 70 years, right? Just the job opportunities dried up. It was just a tough periods. But what we're seeing is just it's the same thing that every other generation does. It's been delayed because of the economic implications of the prior recession. But people get married, they have families, they start to put down roots in their community. They find a place that they want to stay and they want to make it their home. And right. And part of that is owning a home, right? That's here we are. It's just happening later. And then you factor in the implications for the home builders, right? Not building homes over that period because of the reality of there was already way too much inventory. And then this somewhat of a perception that this is a generation that maybe they're not ever going to really get into home ownership in the same way.
Yes.
And now, hey, guess what? Reversion to the mean, right? Here we are, full circle. So here we are, full circle.
Yeah, everyone, 5 years ago, everybody was talking about the millennials are generation rent. They're never going to buy houses. It's just not in their DNA. It's not what they want. And that never made any sense to me because no generation is profoundly that different from the other generation in terms of that kind of cycle of life. I think the millennials just had more to deal with. And, student loan debt, I think it has been a big part of that. And one thing that may be interesting for this year is some of President Biden's plans for housing, planning that $15,000 first-time homebuyer tax credit. That that could be a huge incentive because that sort of can help with the whole down payment thing. So that may be big. There's been some talk about, forgiving certain amounts of student loan debt. That could also impact first-time home buyers as well. So you've got these other factors too, where you've got an administration that is also going to be focused on affordable housing, but on increasing homeownership in general.
Yeah. I think it'll be interesting to play out. There need to be some sort of incentives, right? And I think largely this is just going to be an economic supply and demand thing, right? We're just so far behind on supply build, and demand is, there's going to be ups and downs, right? Economic things happen, interest rates, those things will happen. There will be cyclicality, but I think the greater trend is still just supply and demand. There's not enough supply and there's enormous demand. Well, I see some stuff in Q&A here. I don't know if we want to spend a few minutes in Q&A.
Yeah, let's talk about that. I wanted to address this question from Tony about what happened to home builders in 2009 and what risks if the Fed tightens policy or if we see inflation, because I think that's important. There are things to watch out for. So there are things to watch out for, like if interest rates spike up, which I don't think either of us is thinking is going to happen this year or even next year. I think it's going to be, when interest rates rise, I think it's going to be a very slow and kind of cautious process. But there are other things, if we see existing home prices suddenly drop, or the existing home inventory that I talked about earlier, if that suddenly spikes, there's a couple of things that could happen that seem unlikely now. But if there's anything that we learned from last year, it's never rule anything out.
Oh, that's exactly right. Just a reminder for anybody that's new to Fool Live or just tuned in, be sure to hop into Slido to get those questions to us. sli.do in your web browser and event code MFLive. I want to address Tori's right here at the top, talking about home affordability and talking about increased defaults in the future. So Tori says, as people strain home affordability, could that cause increased defaults in the future? And Tori mentions potentially like a 40-year mortgage. I don't know if there's really any appetite for a 40-year mortgage, but maybe, right? People are living longer. If some regulator approves it, maybe that's part of the answer. But I think at the end of the day, I think home affordability is, you have a number of factors that come into play here, right? And the biggest two are the cost of the property and interest rates, right? Those are the two big things right now. And the fact that interest rates have absolutely plummeted, and it seems like the Fed's mandate, and I don't anticipate this will change under a Biden administration, and whatever happens in Georgia and how that affects Congress, whether we have a split legislative body or we have Democrats running the whole show, I don't think that's going to affect low interest rates for an extended period of time, right? So, but I think in terms of answering the default question, I think that's going to come down to whatever the next economic downturn looks like, right? So nobody saw this being what it was, right? Nobody anticipated, a once in a century pandemic causing the next recession, right? It wasn't on anybody's radar any more than the last financial crisis was on very many people's radar, right? So the other part of this that I think is important is we've never seen this sort of economic stimulus provided, right? And the bottom line is that we still don't know how the lenders are going to have been affected because there's still so much money being pumped into the economy that's offsetting people's ability to continue to afford to pay a mortgage. We don't know, right? And it's probably going to be another year before we really know. But here's the biggest question to me is whatever the next economic downturn is, how does the government respond at that time to support the economy? Has this changed the expectations that the government's role is now to pour trillions of dollars into the economy to prop it up? Or is a more natural, normal economic cycle going to be allowed to occur, right? I think that's the biggest unknown right now. And I think at the end of the day, that's more of a risk for banks than it is for home builders. Home builders just have a great opportunity if they manage their balance sheets in any sort of responsible way and make sure that they're operating in good markets. The next decade should be fantastic for home builders.
Well, and I feel like the other factor is that this one is just going to run differently than the last one for a few reasons. I mean, sure, you've got forbearance right now, you've got some eviction and foreclosure moratoriums in place, and that's a factor. But the other thing that happened during the Great Financial Crisis that I think may play out for home builders is during the Great Financial Crisis, you had the creation of things like Invitation Homes and other single family rental giants that now own 50, 60,000 rental properties. I would suspect that if there is if home builders do run into trouble, a lot of them will probably be able to find if they do have homes sitting there, they will probably be able to find a bunch of different ways to turn those homes into rentals or something like that. I don't think we're going to see a situation in which we see a massive amount of foreclosures sitting around. I mean, also we have iBuyers, which is something we didn't have in the last cycle. So however the next cycle plays out, it's going to be a very different ball game than it was before.
Yeah, because just the biggest thing is the supply, right? There was just so much excess inventory last time around that we don't have. So even if we do see a spate of foreclosures, to your point, the market's already ready to absorb them, completely ready. Mm-hmm. So that changes the dynamics completely. Let me grab, let's see here, Mabel's. I see you, Mr. On, by the way. I see you. Mabel's saying, do you think valuations of home builders and related stocks have reflected the housing shortage and low interest environment? This is a good chance for me to show a chart I have here. So this shows some PE ratios. These are forward PE ratios, right? So the top one in purple, so you see the forward PE ratio for the S&P 500. So for the next 12 months, it's projected to be 39 times earnings. That is a historically high rate, right? It's not the highest ever, but it's incredibly, incredibly high. Now you look down at the bottom and I put a collection of home builders. We have Lennar, ticker LEN. We have Green Brick Partners, GRBK. So these are like two opposite ends of the spectrum. Lennar, one of the biggest.
Very big and very small.
Right, very small, right? And then you have Toll Brothers, ticker TOL, and they focus more on custom and luxury homes. That's kind of their thing. Then you have LGI Homes, ticker LGIH, and Meritage Homes, ticker MTH, who both focus very much on entry level. Meritage is top 10. LGI is pretty close to top 10 if they're not there yet. And then you have NVR, that's the ticker NVR, that is more of a mid-Atlantic, but they're kind of the gold standard in a lot of ways. They were profitable back during the financial crisis. They're really good at managing their balance sheet because they've kind of been the big innovator with using options to manage almost all of their inventory. So anyway, you see all of these, and you see NVR is the only one that trades for more than 10 times projected forward earnings, trades for almost 13 times earnings. And then these other guys are way, 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 way down, right, in terms of the forward PE ratios. And that's even after they all just absolutely crushed it last year, right? So there's a couple things happening here. Number one, the PE ratios are low because analysts are projecting record years, right, for all of these guys, because you look at every single one of them and they grew their order books by, I don't know, I think the lowest I saw was NVR grew their order book by like 40%. Some of these small guys grew them like 60, 70%, right? So just these massive order build, those are firm orders for a house, right? That people can walk away from them. But I think even you back out that average of like 15% order cancellation, these guys are primed to have absolutely massive, massive years. So what's happening here? Investors are expecting, they're always looking forward, right? So they're expecting, sure, 2021 might be a great year for home builders. But what's 2022 going to be? What's 2023 going to be? What's going to happen this summer when things do return to normal and now people are going on vacations and they're traveling again and they're deciding, well, maybe I really don't need to buy a new house, right? So there's a lot of kind of looking past those order books and expecting maybe the best is already baked into the stock prices. But it's also a fact, again, the leverage and all of those things that normally make them less valued, right, in terms of the multiple premium you see. But to me, here's what it comes back to, right? It comes back to this big chart right here, where you have just, the huge growth in the U.S. population, and you have the least amount of existing single family home inventory in history, and the largest number of first time home buyers in history, right? So that's to me. So I think for a foolish investor who's looking at a 5 to 10 year investment or longer, I think it's a good idea to be looking at home builders with the understanding that they are cyclical, they're leveraged, and you need to pay more attention to them than you might to, say, Berkshire Hathaway, for example.
Yeah, they definitely are going to change. And a lot of the home builders that you mentioned did have hit record highs over the last, especially over the last couple of months. I mean, you talked about Green Brick. Green Brick has just had an incredible run, and and part of that is because they are so small. Their stock is very low priced, and they're positioning themselves right now kind of, I think, for a bigger run. And I know you've been following them, you kind of turned me on to them, and I feel like one thing about them, I feel like what they're doing is very smart with how they have their partnerships with different builders in the locations that they're not centered in.
Yeah, and I think it's a smart approach, right? And you leverage relationships instead of building enemies. I think, and this is a business because it is so competitive. It's a smart way to make sure you're positioned effectively in as many markets as you can. I think it'd be good if you could. Serenivas's question here. I know there's a lot of interest in learning more about Millionacres, the two premium services, real estate. Real Estate Winner, was it Real Estate Winners?
Real Estate Winners, yeah.
Real Estate Winners and Mogul are great services. You want to give a pitch and explain what they are?
Yeah, sure. So Real Estate Winners is kind of meant for people who are just dipping their toes a little bit into real estate. So it recommends real estate investment trust, REITs, obviously, home builders.
Publicly traded. That's the key. It's
publicly
stocks.
Traded. Yes, yep. Publicly traded. Real estate related stocks and real estate investment trusts. And so it's sort of accessible for anyone. Mogul is it's a mix of things. So it includes some REIT and real estate stock recommendations, but it also includes individual crowd-funded real estate deals. And so for that reason, it may be more suited to people who are accredited investors. So that's sort of a little bit of a hurdle there. And also for Mogul, a lot of those individual crowd-funded real estate deals have a minimum usually of $10,000 or more per deal, usually $25,000. So in order to get the best advantage out of Mogul, you probably want to have a larger amount of money that you want to build your real estate portfolio. Whereas Real Estate Winners, you can start with as little as, like $1,000 or $1,500 and build yourself a nice little publicly traded real estate portfolio.
Yeah, and the other part too with I think it's neat with Winners is the fact that most brokers now, you can buy fractional shares. You have no trading fees. If you have $1,000 and you want to diversify it across 10 different REITs and home builders and other real estate related companies, you can do it. You can spend $100 and invest in each one and build out that portfolio. So I think it's a really valuable service, and I think we would be remiss if we didn't tip our caps to Matthew Argersinger and
Matt Frankel.
Matt Frankel, who were the lead and lead advisor on those two services, and the wonderful work they do, and how smart they are, and having them in your back pocket is why you would join those services. That's the best pitch I can give. I have immense respect for both of them, and they're both very, very good, and they have very good track records of picking winning investments.
Exactly. And they deliver that a top 10 in real estate winners. That is it's just such a great way to get started with real estate. And you're absolutely right. They're so smart about real estate that they're both investors themselves in REITs, of course, but also in rental properties and things like that. So they just have so much wisdom that they share on those services.
I'm going to give a little plug for Matt. I can't name any names yet. We're finalizing the details right after this call, but Matt has arranged for a really, really special guests to come on the Wrap on Friday. Hopefully this afternoon we'll be announcing it on Twitter, but stay tuned.
I'm curious.
Yeah. Very big name. Not in real estate, and not even specifically in finance, but so we've got a really potentially big name that we're just working out the details on after this. So stay tuned for that. I'm pretty excited about it, actually. Pretty excited.
Awesome.
So, okay. Any other, let's see here, go through this. You see any other questions in the Q&A before we talk about our favorite stocks?
Well, I think this question from James is interesting, of like, what else would cause a real estate crash? And are we going to see a real estate crash? I don't think we are on the residential side, but I am worried on the commercial side. And I think I've said this on Full Live before, is that I'm just watching a lot of what's happening with hotels and retail to some extent, not as much office. And I am getting a little nervous about some of the potential for not necessarily a crash in commercial, because I think commercial sort of operates differently in terms of lending structures and things like that. So you wouldn't see the same type of crash that you saw with residential in the great financial crisis, but there's definitely some pain in that sector.
Yeah, and the thing you have to remember is that real estate is a really big umbrella with a lot of specialized categories underneath it, right? I think so. We're talking about residential real estate now, and specifically a lot about home builders, but then you have within commercial you have 100 different things. So you think about industrial properties, right? I think industrial properties also have a great path ahead with the growth of e-commerce, with the global supply chain crunch because of the coronavirus, where we could see more local manufacturing happen. I think office to me is probably the biggest question mark, right? Because it wouldn't take a lot of big companies saying, okay, we're not going to go to remote, but we want to have a hybrid model. And let's say a company that has 100,000 employees says, we're going to go to a hybrid model. Where the majority of we expect we'll have 20% less employees on site every single day. They need 20% less offices, right? Just boom, just like that. So if a lot of companies switch to that model, it could create a scenario where they're over the next, and it doesn't happen overnight, right? This is the kind of thing that takes a few years to play out, where there's a lot of office space that needs to get repurposed, right? And I think that's the biggest thing, is seeing how that transition happens and how that property is repurposed is probably the thing I'm most interested in. I don't see, it's just so hard to predict a straight up crash, but that you could say that every time, right? And then something unexpected happens and there's a crash. But I think it would be more nuanced and specialized in a kind of a specific sort of area of real estate. So we'll see how that plays out.
Well, yeah, I think economists like to keep predicting it the same way with certainly with real estate. For about 4 years, I kept hearing, this is the end of the cycle. We're extra innings, last innings. It's like now who knows?
Yeah, so we saw the same thing with the stock market boom too, right? You go on the record decade bull run before you finally have a down year, and then you have the worst recession in history, and the market gains 18%. So it's short-term bets are always risky, right? That's the thing. Predictions are fun, but they're not investable. So
exactly.
All right. So we got about 10 minutes left. We should probably talk about some stocks we like. What do you think?
Yeah, absolutely. So I put some of the tickers in the chat for people because I know a lot of people were looking were looking for those.
Yeah. So for me, oh, go ahead. I'll let you go first here. Talk about what you like.
Well, I just want to mention Green Brick again and sort of
Mhm.
explain a little bit about what they're doing, because I think that's really it's really interesting. So they currently are, I believe they're mostly centered. I think they're based out of Plano, Texas. Is that right?
Right. Yep.
And so they sort of started off with Texas and then Florida and Georgia, and now they're I believe they have a partner in Colorado. So
Yep.
they're they're much smaller. The price of the stock is so much lower than, per share than other than some of the other builders. But I really think that this is one that is kind of under the radar. I hadn't really heard about them until you started talking about them. But then the more I look at what they're doing, the more I like it.
Well, market cap's still less than $1 billion, right? And
Yeah,
that's
yeah, they're a
the
baby.
LGI Homes is market cap's about 2.1 billion, so it's more than double, and it's even it's in terms of the smallest. In terms of wait a minute, no, I did that's revenue. Okay, that makes sense. So yeah, did less than $1 billion in revenue. Now let me look at market cap here. So it's probably about the same. Okay, so it did get over $1 billion. So it's $1.1 billion market cap. Still tiny. LGI 2.7 billion. As a comparison, Lennar, is a $23 billion company. NVR is about
Exactly. Yeah.
15 billion. So it is tiny, right? So, and here's the thing, right? So I think investors should be careful. I just want to stress this real quick. Don't automatically say, well, Green Brick's going to be a $20 billion company in 10 years. That's not fair because home builders don't just scale up like that. This isn't
No.
Zoom, right? Where it gets those kind of incremental margins.
It's a lot more difficult to
Right.
scale up that quickly as a home builder.
It's literally a picks and shovels company, right? They're using picks and shovels and backhoes and all that kind of stuff. So there's a lot of operating expense. Now, yeah, one
Right.
of Lennar's strengths is because they are so big, they do get leverage. They get buying leverage. They buy lots of land. So they do get benefits from their scale, but they're not as readily apparent as they are in other industries. But they can be more nimble, right? I think that's one of the things that's really interesting about these smaller companies. So, okay, what else you got?
Well, do you want to talk about Meritage and their? I believe you wanted to talk about losing their CEO and kind of what that means for the future.
Yeah, I think it's really important. So Meritage Homes, it's been a stock advisor recommendation for a very long time. And one of the theses behind the recommendation was that it was, led by the founder, the CEO, Steve Hilton,
Hmm.
who read the company obviously since its founding. And he just announced he was retiring a couple of months ago. It was a little under the radar. Just he's not a big flashy guy, but announced he was going to retire, and he's retired. And it's important whenever you have somebody who is so instrumental in really every phase of a company's history, and led the company to enormous returns for investors. When they leave, I think you just have to pay a little bit. You have to pay a little bit more attention, right? So the good news is that the company has a really good stable of executives already in place.
Hmm.
Um, its board has been pretty stable, has a steadying hand on the company. So my expectation is that this is going to be steady as she goes, right? This is a company that already has a very clear goal, a really clear trajectory to focus on that. This was one of the first. I think this might have been the first of the top 10 home builders to explicitly state we're going after starter homes. It's been almost 5 years ago since they stated that goal, and then they immediately started buying properties based on developing starter properties. So they already have a path, right? It's just a matter of having a steady hand on that rudder to keep the company moving in that direction. I'm going to pay more attention over the next few quarters to hear what their CEO has to say. If there's any major changes in language or performance, right? That's the big thing, right? Do they continue to
Yeah.
deliver? Are the returns made good? Do their margins continue to improve? Does their order book continue to grow? As long as the business continues to perform, there you go. That tells you what you need to know. So it's
Yeah.
worth watching. It's worth watching.
And their earnings is coming out. the tail end of January. So we're just starting to see home builder earnings. Lennar's came out end of last month. They're actually early. They tend to run earlier.
Right.
And one of the things that I found interesting about looking at Lennar's earnings, and one of the things they're talking about is I mentioned build to rent earlier, and I see that as, as housing affordability gets tighter and tighter. There's a lot of people that still want to have a single family home, even if they have to rent it. And I think we saw that a lot in COVID-19. We've talked about residential prices going up, but one thing that it has been interesting is the condo market has not been going up at the same rate, and condos are significantly lower, especially larger buildings, partly because of COVID-19. You're seeing a lot of available inventory actually in condos and buildings, and you're also seeing prices not going up quite as much. So single family build to rent is one of the reasons that I like Lennar. The other reason that I like them too is they're doing some interesting things, because they are the biggest, because they are doing, thousands of homes every year. They have the ability to sort of test out new ideas. So they've been testing things out like multi-generational homes, which I feel is going to be interesting, especially as baby boomers continue to age. Are we going to see more families buying a home that then has like an in-law apartment? I think that's one thing that I find interesting that some of these home builders are doing.
Right. What is old becomes new again, right? This is
right?
a transition to something that was very normal, 50, 60, 70 years ago, 100 years ago, and doing it again. And maybe that's part of the answer to affordability, right? I think that's,
it absolutely is.
Yep. You have an aging family member, a parent who's ready to downsize. You have a young family, your affordability is an issue. Aging family member downsizes. All of a sudden you have cash to buy a house and make it affordable. So it'll be interesting to see how that plays out. It really, really will. I think probably the one thing I just want to leave everybody with is, again, I want to highlight the bigger trend that we talked about, that to me is just, I think it's still really under the radar because there's so much focus on affordability, which is a real problem. And I think it's a generational issue because there are so many people on the margins that buying a home is not even remotely possible. But as an investor, you look at that big trend, the convergence between existing home prices and new home prices that are squeezing together as that inventory of existing properties continues to fall. And then you have this massive generational shift to the largest number of new home buyers in history with the least amount of inventory. It sets up home builders, the home builders that know how to operate and that have a track record of executing, to have a great decade. With the caveat, there will be bad years, there will be bad quarters. Every year is not going to look like 2020, right? And you have to be prepared to ride that volatility out and think about how you want to invest and how you want to risk your capital.